Okay. Good day, everyone. Just please give us a maybe 30 more seconds while we just wait for everyone to log in, and then we'll get started. Okay, just a little bit longer, and we should be underway. Okay, I don't want to hold things up for too long, and we've got a fair bit of material to get through. So let's just make a start on the intros. So thanks everyone for dialing in today. I think we have over 800 people registered to join today's call, which is great. Obviously, such is the interest in the market at the moment. So the next kind of 50 minutes, probably Tanjiang and myself will take you through the latest ODCE performance numbers for Q1. So I'm pleased to be here in our Chicago office. So good to see you there, Robbie.
You're in Chicago, Phil? I thought you were putting like a New York background or something. I didn't realize you're just a couple doors from me, man.
I'm 2 offices down from you. Still don't want to be in the same room as me. But there we go. But yeah, so this is kind of a precursor to us going out on the road and speaking to our clients on a one-to-one basis to run through the analysis over the coming weeks. So what we're presenting, as I say, are the results on the entirety of the ODCE. That's the 26 portfolios, and within this we match up our valuation data set to provide added intel into the analysis. Before I kind of just get started and pass over Robbie, I wanted to stress how this webinar is very much a collective effort. So thanks to everyone involved in pulling together the valuation information. So that's the wider advisory team, the performance team, but also not to forget our wider client base. Thanks to them for providing us with privileged access to their data, and also to NCREIF for putting together the performance benchmark numbers. So last quarter we did a few polling questions. We've got a similar set of those today. So maybe just kick off, Robbie, with where we started last time round with the polling question we finished off with. So let me just move my slides on, and we'll get to where the question we asked last time. So Robbie, over to you.
Yeah, so yeah, thanks, Phil. I think on last quarter we asked this question, right? So what do you expect the total unleveraged property return will be in 1Q 2023, right? So if you look at it, majority of participants indicate between -2% to -4% in total return perspective. So which is about 50%. That's about right on to the return this quarter, right, Phil?
Yeah, it's pretty much where the number ended up, maybe at the more conservative end of that number 2 range. So there's your number in the top right-hand side, a negative return of -2.2%. So just to clarify, Robbie mentioned it there, we're presenting here on just the pure real estate side of the ODCE. So there's no cash, there's no leverage. This is just the actual performance numbers on the real estate and how that's been playing out. And these are total return numbers, so that's income and appreciation. So the market did continue on its downward trajectory, and then it posted another negative return for Q1, -2.2. The operating asset return does come in a shade below that. So the difference between those two sets of numbers is the inclusion of development properties, and a lot of those, I guess, valued at cost. So in a declining market, that will prop up some of those performance levels. But the general contraction of returns, I guess, will come as no surprise, given the continued uncertainty around the economic backdrop, the overall elevated cost of capital, which is a collective of continuing to put downward pressure on the market. But the level of decline you can see there has eased from Q4. Q4 number was -3.9. And that easing off was apparent in each of the main property types as you go down the list here. and we've ranked those in terms of color coding, north or south, green and red, of that overall stabilized operating asset return. Offices remain firmly rooted to the bottom of the stack, dropping actually further adrift from the other sectors with a minus 5.2% return for the quarter. And actually such is the demise within the office sector and the pullback on the overall ODCE that in Q1, this is the only property type to come in below the ODCE average stabilized operating asset return. For apartments, the pace has slowed to minus 2.3%. That's actually level set with the overall ODCE. Industrials have easing up a little bit more to minus 1%. Storage, or the other component, which is primarily storage, a shade better off at minus 0.8%. And retail's the one sector not to have posted a negative return. So with all sectors, with the exception of retail's returning negative, the challenges facing the real estate market are still fairly broadly based in Q1. Something that we started to report on last time was this bottom set of numbers here. That's the spread in performance from the top to the bottom performing sectors. So offices now being cast further adrift has moved that spread of returns slightly further out from where it was in Q4, but it's notably less divergence in these returns being played out between the sectors than we saw during the back end of 2021 and the early part of 2022, when we were looking at double-digit spreads in returns. So, and that's when you saw the real contrasting fortunes between the strengthening industrial performance and the more tepid retail and office sectors. The spread is kind of more closer to what might be termed a long-run average, and what that means for portfolio levels of return, I'll turn to in a while. Continuing with the returns, now this looks at performance numbers on an annualized basis. So we're compounding the 4 quarters up to Q1 of each year. And then on the right-hand side, you've got an annualized set of numbers over a 3-year time period. So really showing how the performance levels have played out since effectively the onset of the pandemic. What it helps illustrate, if you just look at that top line, is just how variable the market has been over the course of the last 3 years. We focus on that overall property line. You go back 3 years ago, and you begin with the immediate setbacks associated with the pandemic, a return there of just 3%. So included in that, you've got a negative return on appreciation, negative appreciation of 1.3% to be precise. Through 21 to the start of 22, the second column, you then have, let's call it that post-pandemic growth spurt. And if you look across the sectors, this is when industrials were simply in a league of their own, a return of over 50% in that year, and a huge divergence between the kind of growth sectors, contrast with the single-digit returns that have been achieved in the retail and the office sector. Roll forward to phase 3, let's call it, that current period of correction, returns are now negative overall. Most of that contraction, you can see, stems from the office sector. Apartment returns are also negative. Industrial and retail performance numbers not much better off. No one sector really avoiding the repricing the market has been encountering from the increased cost of capital and the general uncertainty that's been shrouding the markets. Averaged over the 3 years, industrials are still very much the front runner, followed by other, which I say is mainly self-storage. The apartments pretty much level set there with the ODCE overall, and they've been pretty close to the average levels over each of the last 3 years. At the lower end of the spectrum, retail returns barely positive, still feeling the effects of those earlier performance setbacks, and offices now at the bottom of the stack of sector clearly under intense scrutiny. When you break the kind of portfolio returns within the ODCE down, and this is a very simplistic approach we're adopting here, but trying to assess how much the variance in performance across the ODCE funds is either allocation or property specific, the long run average works out to be about a 70-30% split. So what that means is 30% of average portfolio variances within the ODCE are down to how much these portfolios are invested into the different sectors versus how well their properties are performing within those sectors. I should stress this is just conducted at sector level. So even then, the kind of allocation element of the average return kind of gets as high as 50% when we're looking back in 2022, which is pretty staggering, I say, for a group of funds that are balanced across sectors by definition. The returns have now closed in across the sectors, and you're getting more closer in terms of that long run average split between allocation and property specific. But that blue bar, or the orange bar, the allocation piece, is significantly being understated, I guess, in this analysis. Now, this is just looking at allocation plays within the at sector level. You've also got to consider allocation strategies within the sector, so geographical plays within sectors. And also, this is the average, and if you look at the two ends of the spectrum, then allocation does play a far bigger role. This is the kind of analysis that we discuss with our clients on a one-to-one basis, what we're going through over the course of the next few weeks, but I thought I'd just kind of share that with you at this stage. Let's go back to the quarterly returns, which we've unpacked here into the income and appreciation element, putting the current set of numbers into an historical context. Before we get into the swings in the appreciation returns, the first point to note is this quarter we've seen a slight rise in the income return up to 1%. This, by definition, is the return on income over capital, and as the capital base has been declining, the return on income has effectively risen. I mean, NOI levels have been in the ascendancy, but less so in recent quarters. But the big swings are on the appreciation side, and this illustrates just how quickly the market has turned on its head over the course of the last 12 months. That value decline slowing from -5 in Q4 to -3.2 in Q1. And all in, value decline has taken 8.5% off property values in the course of the last 9 months. But prior to that, let's not forget, we had 7 consecutive quarters of rising values. So values are still only 6.1% down over the year. If you backtrack over 2 years, they're 11% ahead of where they were. And you bring back in the write-downs associated with the start of the pandemic, and values are still near 10% of where they were pre-COVID. If you look at that visually for the 1 and the sand color bars and the 3-year changes, we've then broken that down here across the sectors. So putting that current period into a historical context for the 3 years. Office values here are down at 17% over the last 3 years. Most of that decline you can see coming through on the sandbar in the last year. Retail values down 12%, but only a small part of that is recent. Most of that decline was at the start of COVID. Industrial values are staggering, almost 60% ahead of where they were 3 years ago. And that recent reduction is really just a minor blip on that. And again, this just shows how polarized the market has been. There's nearly an 80 percentage point swing there in value movements in those purple bars over the last 3 years. Returning to that prior chart, where it gets interesting is when you start to look at the makeup of those red bars, the appreciation return, how that kind of current reversal has been playing out in the market. And what we're able to unravel at Altus, using our kind of extensive valuation data sets, how much the movement is a product of pure economic fundamentals versus what might be termed the investor sentiment. So we first of all transpose the red bars there onto the red line in this chart, and then bifurcate or decouple that appreciation into what's termed the yield versus the cash flow effect. The yield effect, the yellow bars, is the impact on what might be termed just the pure pricing levels on value. So that's the impact of the change in discount rates and exit caps. That's the capital market side of the equation. For the cash flow, the blue bars were identifying the impact on the changing value from the change in those forward projected 10-year cash flows, changes in rents, costs, lease terms, occupancy levels will all be playing into those bars. This really does illustrate now how much of a roller coaster ride the market has been on from both an economic and a fiscal standpoint. I mean, it's the catalyst, I guess, behind the recent decline has obviously been the events that have been played out in the wider fiscal markets, the move by the Federal Reserve, increasing interest rates to combat those rampant levels of inflation. The impact on real estate values started to be felt back in Q2 of last year. We've now had 4 quarters of rising yields, and they've been stepping up in order of magnitude as we got towards the back end of last year. Interest rates, yes, they're significantly elevated compared with where they were 10 years ago. That's presented the market with significant liquidity issues, not to mention the issues that have been playing out in the banking sector. Throw into the mix the challenges associated with the need to restructure debt as loans mature, all of which is effectively resulting in finance being withdrawn from the marketplace. Putting some actual numbers in there, The pricing offset took, what's that, 2.9% off values in Q1. That's less acute than it was in Q4. So maybe signaling the worst is now behind us, but possibly with those recent interest rate increases again by the Fed, maybe more to come. But it's then the interplay between the two component parts that's led to that overall reversal of fortune through the course of the last 12 months. And the overall value change relates as much to the cash flow side of the equation, which is obviously intrinsically linked to the underlying economy. And that may be a mixed picture, but I was at NCREIF recently and the talk definitely turned from will to when will the economy go into recession. And our cash flow metrics are definitely mirroring that change in sentiment. Now, just 2 quarters ago, cash flow gains were running above the long run averages, combating any movement out in pricing metrics. By Q4, those cash flow gains began to be scaled back and quite significantly, offering up very little protection to values, and roll into Q1, those cash flow levels are factory static. In fact, they've actually started to contract again, something that we've actually not seen since the onset of the pandemic. So, Robbie, over to you. What's your kind of general read on what's happening in both on both the fiscal and the economic side of the equation? And
Sure,
maybe from a pricing standpoint, is worst behind us now?
Interesting question. Yeah, so before I answer it, again, I think just a reminder, if people have questions, please type it into the chat site, right? So put the question in there and we will kind of try to address it either throughout the session or at the end of it, right? So, but yeah, on your question, are we done with the decline, right? So there's definitely still a lot of uncertainty in the marketplace today, right? So if you look at it, the Fed just increased 25 basis points. Although there's a hint of a pause and actually market anticipating a decrease in rate based on the Fed fund kind of future trading, right? So, but there's still a lot of mixed signal out there to look at, right? So inflation definitely moderating, right? So, but on the other hand, you see the employment growth or job growth, hourly wages have been higher than most people projected, anticipated, right? So with unemployment actually dropped to 3.4%, which might mean that inflation may be more persistent than what market anticipated. If that's the case, it could have a divergence between kind of the Fed and the market, right? So on top of that, we have a banking kind of crisis today, which kind of in a sense muddy the water further, right? So financing already a challenge, right? So especially with the bank pullback, with the recent kind of banking situation, that will definitely impact our real estate, right? So investor hit uncertainty, and we still have tons of them today. Not everything is bad, though, right? So if we're kind of going through this session today, we're going to talk about like fundamental are generally still strong, except for the office, right? So, and we start seeing some footing in some property sector. There's transaction going on, industrial, apartment, retail that kind of support our current valuation today, right? So if you look at transaction volume as well, industrial apartment are generally healthy. Yes, down from 22. But it's kind of more more back to the normal level prior to kind of pre-COVID time. Overall, I would say it's still more positive sign on this quarter compared to previous quarter for sure. But it's still too early to tell whether the decline is over, right? So uncertainty is still here.
Okay, thanks for that added context, so Robbie. And you started to talk about their sector, so let's go there next. So on the next slide, so we're taking this relationship, playing it out across the 4 major food groups. You want to be focusing on the right-hand side of these charts. We shorten the time series so you can look more at the makeup of appreciation over the period of the pandemic or since that kind of kicked in. Looking at the Q1 bars on the right-hand side, the first point to mention is that pricing offset, the yellow bars, with the exception really of offices, notably less acute than it was back in Q4. The cash flow metrics, the blue bars, though, have been scaled back, with the exception, though, of industrials, no let up there. And that's really the only sector to see any really quantifiable improvement in cash flow levels in Q1. Down here, retail cash flow is pretty much static. Certainly no improvement as households are very much, I guess, tightening their purse strings. Apartments actually starting to see some reduction as increased costs come into play. And then on the bottom left-hand side, there's really no let-up, as I say, when it comes to the office sector, not just pricing, but cash flows coming under further pressure. Substitute out on the top right-hand side there, the industrials for the other, again, which is primarily self-storage. Cash flows here also at a standstill. But from a pure pricing perspective, as maybe with the retails, a lot of that correction maybe looks to now be behind us. Who knows for that for certain. I do want to delve a little bit more into those yield and cash flow variances. So here, the sectors on the left-hand side and those red bars are ranked in terms of appreciation. Then we're decoupling the yield and the cash flow effects. This is just for Q1. You can see this on the size of those orange bars that it's yields that were really the root cause of the write-downs in Q1, but it's the blue bars, the cash flows, that were determining some of the hierarchy across the sector. So while industrials, and they still did experience the largest offset on in pricing in Q1, this is the one sector on the industrials that were afforded some protection to values from those improving cash flows. There's not a great deal to separate industrials from offices there to there in terms of from a pure pricing offset standpoint, but the difference for offices is that decline in values, both yield and cash flow related. So it's that double negative that puts them at the bottom of the stack. And whatever you look, where you look at it, pricing is having the biggest bearing on value movements. And that certainly dominated the narrative again at the NCREIF event that I was in Phoenix a couple of weeks ago. I think the interest rates then were, in the polling question, were ranked as the most important consideration for value change in 2023. So let's open up those yield metrics first, and maybe just you can pick up on this one, Robbie, in terms of maybe the point of conversation for a lot of people is going to be the order of magnitude of those yield increases on industrials versus offices, very similar in terms of the level of changes they saw in Q1. So maybe you just want to pick up on this slide, Robbie.
Sure. I think you can see in here, right? So pricing adjustments still occurring for all property type. I think that you look at over the last year period, industrial seeing the largest adjustment just because they're starting with the lower pricing to begin with, right? So, and then there's transaction for sure, right? So transaction industrial side, generally for shorter term wall can support valuation. What we see a lot of adjustment this quarter is a lot of cases to the longer term wall asset, right? So I think you look at as well, like generally, I know we don't have a slide compared to previous quarter, right? So pricing adjustment generally are lower compared to previous quarter, except for the office. The office continued to be kind of similar to previous quarter. On top of that, I think we continue to see the risking of the cash flow, right? So with more negative cash flow, right? So office continued to be challenged in both fundamental and capital market side.
Okay, thanks for that, Robert. Okay, I'm sure there might be some questions on that coming up in the chat box, so we'll look out for those. Turning to the cash flow side, which started to stall this last quarter and possibly started to show some signs of frailty, which here we're relaying to a series of 6 key valuation metrics. The bars for those valuation metrics show the change on that metric over the quarter. I think we said this before, but there's no perfect science to that color, but the color coding gives you a sense of whether that's having a positive or negative impact on those forward projected cash flows, which are then feeding through to the valuation change. So first off, occupancy levels down across the board, but by less than kind of a 1% for each of those sectors. Market rents, contract rents in green, so still moving in the right direction, but only really minimal change when it comes to the retail and the office sectors. And for the apartments and the industrials, those market rent gains have also then been pegged back by those reductions in those forward projected growth rates. And these changes are in the 10-year growth rates. So let's open those up below in terms of years 1, 2, and 3. And for the apartments, most of that cutback, or pretty much all that cutback, is in the year 1, so possibly reflecting an anticipated short-term nature of the economic setback. Maybe get your thoughts on that in a second, Robbie. Whereas for offices and industrials, while coming both of those off different growth rate levels, those reductions continued into years 2 and 3. The operating expense ratio here, though, which is the change in the projected operating expense as a percentage of the anticipated rent for the next year, is really where it's all at for this quarter. Last year, with the exception of offices, this metric was greens across the board as revenue gains continued to outpace back in Q4 the escalation in operating expenses. This has now turned red across the board as any increases in rents are effectively now being cancelled out by the rising operating expenses. Added to which, for the office sector, which is spiked out in particular, you have rental concessions in there, you have adjustments to stabilize occupancy, further reducing those near-term NOI levels. And that's really what appears to be having the more immediate impact on office values. Offices on the right-hand side are also seeing the larger increase in budgeted capital costs. We've seen this in prior quarters as well. And this increase, we assume, is linked to the general realization of the need to invest more into those office assets to ensure they remain competitive in the wider real estate landscape. So, Robbie, what's your general read across the sectors when it comes to these fundamental aspects?
Sure. I think the industrial is kind of continue to see continued growth, right, in market rent with a tight vacancy market. Most market reporting higher rent. That's why you see the big green bar there, market rent. But there's still like headwind with economy and slowdown in port activities, right? So therefore, you can see market rent growth have been tapered down to this uncertainty. On the apartment side, interesting sector, how I said, the near-term supply definitely have an issue in some of the market, which impact kind of the near-term rent. That's why you can see on that side that the year one number is kind of lower on the market rent growth, right? So, but long-term, most participants are relatively bullish for this sector for several reasons. One is the underhousing in the United States. Second is with limited financing for development and higher construction costs make a lot of the development not pencil out, which is going to slow down future development, right? So that's kind of good as well in the midterm once the near-term supply been kind of like addressed. And then affordability, right? So in relationship with the home ownership. Overall, that's why you see the decline mostly in year one rather than 2 and 3. Operating expenses definitely impact this sector, right? So you get increase in property taxes, insurance, and labor costs. Office is definitely a big question. People are going to ask why the market rent is flat, right? So there's one thing in there. This is just a face rent, right? So you see a lot of market report out there asking rent generally is up, right? So, but that's kind of more on the face rent basis, right? So not necessarily net effective rent. And if you look at it, TI and concession are generally higher, right? So which resulting in lower net effective rent, which is actually shown in operating expense ratio and capex ratio, right? So, and there's several other things that's not reflected in this chart. The longer term downtime, right? So the higher general vacancy. These are all major contributors to the negative cash flow in the office side. Retail generally uneventful, right? Quarter, right? So we'll talk about a little bit more later on. Another category, which mostly self-storage, are seeing positive rent growth, which, but again, offset slightly also by higher expenses and capital.
Okay, thanks, Robbie. Good extra context there. We've got the slide for 3 years. Won't go into the same level of detail, but just if you do cast the results back over 3 years, that left-hand side, there's that spread again. That's an over 20% per annum, and those appreciation results between the different peer groups. And pretty much all that variant being played out on the blue bars, the cash flow side of the equation. As yield movements have held back retail and office values a little, but most of it's on the cash flow side. And actually, if you look at the yield effect, actually what's interesting for apartments and industrials, pretty much net zero. So that's maybe implying that yields are back to where they were at the start of the pandemic in the industrial and the apartment sector. But given that I guess we're in a different interest rate environment, I guess basically the question as to whether further correction can be expected. Before we get into the detail of the sectors, just a slightly different take. I think we used this slide last time round just to illustrate how much of a step change in terms of valuation corrections the market is going through quarter over quarter. So looks green, amber, red, the percentage split in value corrections quarter on quarter. Look at the right-hand side columns for each of these kind of sector charts here, and you can see how the value corrections on the way down, those red shades are almost as widespread in Q1 as they were in Q4. So no let up in that regard. So this period of correction looks as if it's playing out longer, I guess, in terms of the adjustments than we saw at the immediate onset of the pandemic. It'd be interesting to see how much more red is on the card in the coming quarters. But even with all that red, there's always a little bit of green, even in the office sector. And there's obviously down to property specifics, there's always some assets that experience some level of lease up, and that will sometimes have that positive impact on values. But I think we've just got closing off this sector. Yeah, do you want to ask the polling question there?
Sure. So yeah, which sector will hold out the best for the remaining of the year? Multifamily, industrial, self-storage, retail, or office, right? So I'll give like about a minute or so for people to answer this. What do you think, Phil?
I can guess which one it won't be. And I think A to D, I think there'll be a spread across those. They've all got some positive aspects to them. I guess retail's having gone through that pricing correction, maybe the multifamily industrial. I mean, I've seen similar polling questions, so I wouldn't be surprised if it's spread between A to D, but let's see what comes up.
Yeah, let's see what the result is. Voila, industrial, 52%, followed by multifamily, storage, and retail. It's pretty much clumped together, between 15 to 17%. Definitely interesting. So it's industrials number one.
There's no let up in the industrial success story, is there? Well, possibly based on those polls. Okay, well, thanks everyone for contributing to those, and we'll keep those stored up. Actually, we'll kind of report those back on those as we get towards the back end of the year in terms of how maybe the sentiment does swing. But let's go back to the current quarter, back up to the return levels to see how they've now shaken out across the major metropolitan markets, which we are ordering here from west to east, and these are the markets that we drill into when we look at the geographical spreads for the attribution analysis that we apply for our clients. We'll go into the detail of each sector in turn. So for this slide, as we've done before, we just want to introduce the format and some top level pointers. So to explain the color coding on that top level, this is all relative to the 2.3% overall operating asset return for the ODCE. So to get a sense of either what's accretive or not to that overall ODCE return. The table below is exactly the same format, but for Q4. And the bottom table is how much the difference there was between the last two quarters. And that's pretty much mainly reds across the board as the levels of decline in the majority of markets did ease off in the first 3 months of the year, culminating in that 1.8% uptick in the overall ODCE return. The color coding, if you just go to the top table, is pretty binary in that industrials, retails, and other generally in green, offices pretty much reds across the board, and multifamily, a bit more of a mixed narrative there. If we switch the color coding, so same numbers, but switch the color coding on the next chart. So this then highlights the variances, whether they're north or south, with their respective sector averages. So if you take Miami offices there, which is in green now, because it's holding up better than the minus 5.2% for the offices overall, but 3.6 was previously in red because that's still lowering the overall ODCE return. But this kind of format, I think, gives you a sense of what the leads and the laggards are within the individual sectors, and that's the kind of detail that we want to get into next, where the variance of returns within the individual sector. So let's strip out that middle chart and then just look at the top one and the bottom one. Zeroing in on the apartments, which we shaded up here first of all. So the color coding, again, just to stress, it's all relative to the sector average of minus 2.3% on the top table. The bottom table, you'll note that the returns are generally improving across the board, but still on the top table, still pretty much negative, I think, with just the one exception. The main talking point for apartments has been that power shift between the gateway and the Sunbelt markets, and we're still seeing that play out in these results for Q1. In terms of the Sunbelt, Dallas, Houston, Miami, Atlanta, they're all there in the green, more resilient. Phoenix less so possibly kind of now that past its prime. In terms of the gateways, Chicago, San Francisco, LA, all struggling at the lower end of the order. But New York, starting to fare a little bit better than the overall multifamily average. We're actually starting to see greens on the right, reds on the left, so a bit of maybe an east-west tilt in these performance numbers this last quarter. So anything to read into those trends, Robbie?
Yeah, I think there's two major stories here, right? I think one is a slowdown in the tech and then oversupply market, right? So if you look at it, the Seattle is kind of very right there, right? So that's kind of a combination of both of these factors, right? So Seattle occupancy in first quarter, Seattle vacancy in first quarter 2022 is kind of 4.9, but then today it hit like 6.8 as of first quarter, right? So you can see that the construction actually increased in 2021 with the tech boom, 2021, 2022, right? So, but with recent slowdown, the absorption lagged the new supply, right? So that's why you see weakness in that market. Then you can kind of go to Phoenix and Denver, kind of similar to our prior quarter discussion, right? So there's an oversupply, and to some extent the tech slowdown as well that impacted Denver, right? So there's one interesting part as well, right? So you can kind of look at it, the market with struggle with back to the office also seeing more negative. So, but overall, I would say that's kind of the East and West is kind of tied to the slowdown and oversupply.
That's right. We'll just delve into it a bit deeper. Let's look at just the appreciation side of that return. So that's taking the total return, but just looking left-hand side, the appreciation on that return, and then break it down again into those yield and cash flow metrics. First off, negative appreciation across the board. It's primarily the increase in yields that has reduced those values. There's some varying levels there determining some of the hierarchy. But the mix up in the order kind of really relates through to the cash flow side of the equation. The markets that have held up best have afforded some slight gain in those cash flow levels. But now, over half the markets now, you can see down here, are actually starting to see their cash flow levels contract, and that was kind of a big difference from Q4 when we saw one or two markets contract in terms of cash flow levels. And those at the lower end of the order are being pegged back to A-buy. Reductions, starting to see some of that, reductions in base market rents. In addition to that, you've got those kind of pegging back the growth rates. Cash flow gains down the bottom are also pretty minimal. And then substituting on the right-hand side, the contract rents for the operating expense ratio, we're seeing that increase in operating expense, which is kind of pretty widespread, but also then again putting some slightly larger burdens on those markets, more challenged markets down below. So now thinking about this metric here, Robbie, the cash flow piece. Now, last quarter, say that was only contracting, I think, for one CBSA. It's now contracting on a far broader set there. So is that an expected trend with those increase in operating expense? Might we see further bleed on that? But maybe also your thoughts around just the general pricing levels when it comes to the multifamily.
It makes sense, Phil. I think that generally as well, right? I think the operating expense kind of a more broad-based challenge, right? So it's challenge definitely, especially we heard all the time insurance costs, right? So as I kind of mentioned earlier as well, the wages increase higher than projected as well. So that's mean the expense is going to be higher, right? So you get insurance, property taxes, expenses. That's kind of more broad-based basis. And then you add on a little bit of this, what I call it, the oversupply in some of the market, right? So that's give pressure on the cash flow front. I think on the yield side, what I call it, the capital market side, that's definitely a little bit bright. Well, it's negative, but a little bit brighter, basically this quarter compared to other sector, right? So we heard Freddie and Fannie recently increased the multifamily cap, right, so from 78 billion to 100 billion each, right? So in several transactions, we're seeing a large number of bids, right? So even many of our clients indicating they were outbid in number of transactions, right? So one interesting one I saw is basically one deal in secondary market. We saw over 35 bids, right? So it's a pretty significant number of bids, right? So and the price was adjusted by 6% over from the initial bid to the final, right? So which is surprising. And the deal was closed and kind of got reported for cap rate, right? So again, I think I kind of look at it, the cash flow side, the expenses still kind of continue uncertain there on this, what I call it, the multifamily front, right? So in this quarter as well, you can arguably get seasonality aspect as well. But on the capital market front, it seemed to be a little bit brighter than previous quarter.
Okay, thanks again for that added intel, Robbie. Let's just drop a sector down then. Let's look at the industrials, which are now ordered up here. See from the lower table again, as with the multifamily, those return levels are better off than they were in Q4. Return to the top table, and there's some outliers there on the downside. You've got Denver, minus 4.9. I think we touched on that last quarter. But generally, we're seeing a leveling out in returns across the industrial market on this most recent quarter. Pretty a tight spread, really, in terms of return variances. Now, prior growth markets, the likes of Inland Empire, LA, New York are all pretty similar now to the overall average. There's certain coastal markets are holding out better than the rest. I mean, Miami there positive, 0.8 is a clear front runner in that respect. When you break the numbers down on just the appreciation side of the left-hand side, you can see very, very clearly that there's actually very little to choose between most of those markets, and value declines of around 1 to 2%. And that looks to be coming from this kind of movement out. Well, it is coming from the movement out in yields and a pretty uniform adjustment on those yields. On the cash flow side, the blue bars, there's still positive trade-off between the improving market rents versus the cutback in those growth rates. So those cash flows are still providing what's that, about a 1 to 4% protection to values. So it's only Denver down there that's the one market where we had any contraction in cash flows. I mean, here the occupancy levels are one of the lower, and actually some of that vacancy came on stream actually in the last quarter. I think the vacancy rate there is 84%. And while we saw some vacancy being picked up in some of those Southern California markets, they're still around 97% leased, and most of these markets are kind of in the high 90s in terms of their leasing. So Denver maybe is that outlier in terms of the occupancy level coming in slightly below. So, but Robbie, is that a fair summary? Or would you say that Denver's an outlier, or maybe that's a sign of supply issues to come for some of the other markets?
I think it's a little bit Denver the outlier in this case, right? So if you see the answer earlier, everybody think industrial still strong, right? So I kind of agree on that side. The increase in rent are still shown in most market. Leasing activity, while dropped on 2022, are still healthy, right? So it's kind of back to pre-pandemic level. Overall vacancy nationwide still 3.6, right? So take up slightly with the new supply, but overall demand is still there, right? So it's still not enough to catch up kind of the demand today as well. So it might be take up a little bit here and there. Denver is, again, as we indicate, it's mostly supply issue, right? So the vacancy is 6.6%, which is almost double the national average, right? So.
Okay, thanks, Robbie. So let's move on to the hot topic. So obviously it's clearly the most challenged sector. Color coding again, north, south of that minus 5.2% return for the sector in terms of differences with the prior quarter. In the red zone, another tough quarter for Seattle. Returns in San Francisco, also worse off than they were in Q4, as they were in Chicago, also there in New York. Denver, Dallas also dropping down the order. Larger corrections also coming through now in Boston as well. So in terms of what's in the green, Miami, Atlanta, proving a bit more resilient up top. And when you unpack those kind of performance levels into the appreciation side, as I said when we talked about the sector, the setbacks are as much on the cash flow now as they are on the pricing side. I mean, the worst affected markets down the lower end being impacted more in terms of vacancy, near-term revenues, picking up that operating expense ratio, coming down as concessions have come increasingly commonplace, inflationary pressures being felt in terms of escalating those operating expenses. A couple of anomalies there. So maybe, Robbie, you just want to pick up on the office in general?
Yeah, this chart is interesting. I'll look at it, right? So if you look at it previously, the tech and life science market, the Seattle, the San Francisco, the Boston, generally holding up the last 2 to 3 years, right? So they get development component, they get technology company leasing, they get life science fundamental. But nowadays you start seeing a big move as well in the cash flow effect, right? So, and you got Seattle, as we discussed previously, that's kind of impacted with the tech layoff as well, right? So, and I know that some of you guys wondering why some of them have a positive operating expense ratio in some market, right? So that's generally to the improvement of some of the leasing in that market, right? So not necessarily reduction in expense. Expense still kind of a challenge throughout as well, right? So, and then you get higher TI, basically projecting the cash flow. Still a lot of challenge in this market. If you go to 3-year chart, Phil, so in here, you look at it, there's 5 market now that's more than 25% down, right? So that's kind of pretty interesting as well. You aggregate them, you're not necessarily seeing that number, right? So, and most market are showing a decline, right? So I kind of look at it, if you aggregate them, some questions like why the aggregate on this quarter appear lower than the previous quarter, right? So I think part of it is due to the weighting, right? So the have-not asset, which have been written down over the last several quarters, become less and less weight, right? So the bigger market with the have asset, I call it the life science and medical office, they may be down, but they're still carrying more weight on that basis, right? So if you look at it as well, it's much more broad-based. So I don't think that decline not necessarily moderating yet. There's still a lot of uncertainty in here. I think that's definitely, I think that's still continue to be challenged, right? So, but one interesting note though, I've not brought up Chicago being the worst in any of that discussion so far, right? So it seems like Chicago is moving up compared to previous quarter. We always talk about Chicago being the worst in any other out there. So, but right now it seems like a lot of market, either Chicago moving up or some of the market are moving down to basically accompanying Chicago at the bottom here. So it's definitely interesting.
Okay, thanks, Robbie. And there's obviously there's a whole multitude of factors that are impacting our appreciation. We are trying to do a lot of work behind the scenes, trying to unpick those. I mean, something that we've been starting to look at is the relationship with occupancy level. So here we're charting one against the other occupancy levels at the end of last year versus the 1 year appreciation. It's clearly not a one-to-one relationship, but there's certainly a trend line that runs through that. Properties that have the better occupancy levels, values have held up a bit more. Where you've got a bit more distress in terms of the leasing, you're seeing larger value write-downs. This is run for a collective, as it says here, of some of those more challenged CBSAs: New York, Chicago, San Francisco, LA, and Houston. And this is again something that we'll cover off in more detail when we meet with our clients on a one-to-one basis in the coming weeks. We can also look at variances with age, something we've been asked to look at, and also maybe variances when it comes to this just general the lease terms as well. Another way to cut the office market, and we showed a little bit of this last time, and this kind of starts to play into the NCREIF subtypes, so which they're being reset. So looking at the office market, separating out the suburban, SBD, secondary business district, urban CBD. Sorry, the color coding is maybe a little bit hard to note here, but the dark line there, the CBD values, and if you index the appreciation back to the start of the pandemic, they've definitely seen no surprise that the larger cutbacks, and they've generally been trailing kind of most of the other property types. Suburban there is the lighter shade line, so the values there did in fact increase in 2021, the early part of 2022, but everything's seeing a correction more recently. But again, those downtown office being the harder hit. The other point is within the office market, and this is being pulled from the NCREIF query tool. We don't think we've got the numbers specifically set out for the ODCE funds at this stage, so we can't quantify the impact that they're having, but you can see life science versus MOB versus the wider office market, again indexing those appreciation numbers. Life science at the top, total league of their own, up nearly 40%. MOB also proving a pretty defensive option actually up until the last quarter. Those values were pretty much where they were at the start of the pandemic, a little bit of more of a setback in the last 3 months. And obviously both of those doing better than the wider office sector. Across the retails, where we predominantly look at the results from a kind of property type perspective, subtype perspective. So again, it's mainly movements out in yields, those orange bars that have hit those values this last quarter. Very little improvement in terms of some of the cash flow levels, although the malls actually have seen a bit more upside in that respect. I mean, super regional is definitely a larger category now than regional, but we've seen some upticks in cash flow levels there, Robbie. So any thoughts just on that?
Yeah, no, now we used to talk about office retail all the time. Now is the boring sector, I guess, the uneventful sector, right? So fundamental generally is holding up. You see uptick in leasing in the mall side, so that's why you see some positive cash flow there, right? So both more on regional than the super regional, but there's still pricing adjustment like all throughout, right? So and especially in the regional mall with kind of less trophy mall within it, seeing more impact as well on the pricing side. Major questions still exist. How is the economy going to impact the retail sector, right? So you look at the March US sales is down 1%, although sales are relatively up for the grocery, right? So non-discretionary spending. So I kind of look at it, it's like, well, there's pricing adjustment on the grocery side, but on the 1 year period, you can see that the grocery anchor, which generally in the neighborhood center, are performing better, right? So, but yeah, overall, I think that the grocery will most likely holding up because if we connect with uncertainty with the economy there.
Yeah, and actually, if you look at things on a 3-year basis, those neighborhood centers have definitely proved more resilient. They're the ones where cash flow levels are in the ascendancy over a 3-year time period. And yeah, on the 3-year basis, the malls. So they've certainly been hit hardest with those kind of pricing adjustments. I think that brings us to the end. So just some concluding points there, but I suspect there might be some questions in the chat there. So just summarizing the points there, this is 2 consecutive quarters of negative rates of return, a little bit of an ease off in that performance level from Q4. Offices being cast further adrift, retail is the only sector to not be negative. And if you look at the levels of decline, how they've eased, less of that pure pricing adjustment, but as you alluded to there, Robbie, with the further movement out in interest rates, whether that will revert back. And cash flows are definitely kind of easing off and actually started to contract. And the industrial is the only sector where that cash flow actually provided an element of protection. And offices, you're looking at those major gateway markets, and they are being further scaled back in terms of those return levels, both yield and cash flow related. So, yeah, that wraps up our review. But there, Robbie, you've got access to the questions. Anything that's come through there?
Just a poll, right? Phil, should we run the poll first?
Oh, there's a poll. There is one. There we go.
Yeah. So what do you expect the total unleveraged property return to be in 2Q 2023, right? So it's the same kind of answer that we put, like so 1 to 2%, so some positive value movement between -2 to +1, so i.e. appreciation between 0 to -3%. -4 and -2%, so which means appreciation between -3 and -5, and below 5%. What do you think, Phil? What people will answer here?
I suspect we'll most probably end up in the same bracket, but it might end up being the lower end of that bracket, I'm guessing.
Yeah, so my guess is going to be the same as this bracket, right? So now we give a couple more seconds before we go to the next one here. Okay, let's see the answer. You're right on, Phil. So it's actually majority people thinking appreciation will be negative between 0 to -3% at 48%, but then about equal, like slightly lower, like 43% of it indicate -3 and -5. So it's definitely cluster in the middle, very similar to what last quarter is, right? So.
And if there's more in that B bracket than there was last time around, then that maybe just trend towards an easing off. Who knows? Well, look forward to seeing in 3 months' time, but yeah.
Good. Yeah. So I'll kind of go through some of the questions. Like, so one is on the other data. What is included in the other data? I think some of the participants have asset in kind of the healthcare, the MOB or senior housing. Is it all mostly self-storage? Is it SFR in the other category?
Yeah, so SFR is falling into that category at the moment, obviously, and we're in a bit of a kind of segue here with the NCREIF subtypes exercise. So the student accommodation is primarily in multifamily. SFR is most of that stuff is in that other group at the moment. The largest part, as I said, mentioned before, of other is self-storage. So that's around about 60% of that. You've got senior living, healthcare in there, and then you've got a collection of MOB and life science. I mean, majority of MOB and life science do currently fall into the office sector. We'll get a lot more clarity around that once the NCREIF kind of reclassification exercise has gone through. That life science and MOB will be falling into primarily the office sector. The SFR, I think, will go into a residential category. But yeah, most of the movement in terms of the return has actually been driven by the storage component.
Yeah, and then there's kind of a more general questions like, so what is the yield effect and cash flow effect? I know that some of the cases we explained to our client, right? So we can explain a little bit what's yield effect, what's cash flow effect, and then the other question as well is what is how you determine that allocation and selection within your initial crop there. So.
Okay. Well, let me I'll take them both in turn. I mean, the yield effect and cash flow effect is a scientific approach that we've taken because we have access to all the valuation data. We're able to look at the movements in discount rates and exit cap, well, obviously, which we weight depending on how much bearing exit yields have on value. So there's a scientific approach to it to work out precisely, if nothing else changed on the kind of 10-year cash flows, how much movement would there be in values from pure adjustments in pricing. The cash flow then, as I say, kind of includes a collective of factors that influence the forward projected 10-year cash flow. So where that cash flow component is positive, think of a 10-year cash flow. Is it stronger in quantum than it was in the prior quarter? Is it scaled back? And what we saw this quarter was it kept scaled back slightly, so starting to see some increase in operating expenses taking down those projected cash flows. So that's the way that we calculate those. The allocation and selection, it's a sensitive slide to use in a way because there's so much when you think about allocation. So what we're looking at for that slide previously is just looking at allocation plays towards the sectors and how much, if all industrials, all offices, all retails produce average rates of return, what would those specific relative allocation plays into those sectors mean in terms of differentiating performance levels? But there's so much more to allocation than just kind of straightforward how much you put into the individual sectors. There's allocation aspects within sectors depending on geographical plays. There's allocation aspects within sectors in terms of not just CBSA geographical plays, but downtown versus suburban. So where I said the long run average was 70-30, that certainly underplays the allocation aspects of it. But just going back to my point, I made a 50% swing on performance variances when you look back, that 2021 and 2022 period from allocation plays alone towards these sectors, I think was quite a staggering set of numbers to think of. So, but we break that down in more detail when we talk to our clients on a one-to-one basis.
And that's actually higher, Phil, if you kind of take out because one of the differences as well in the office, life science versus the regular office. Because technically the allocation effect basically is higher during any period of time. Right?
Undoubtedly that allocation number, should, if you do a kind of, I can't think of the expression for it, kind of a total allocation score, then we would be getting a lot higher. And also, if you look at the portfolios that are at the upper and the lower end of the hierarchy within these Odyssey portfolios, then you do see a bit more of an allocation play coming into it. But if that doesn't explain it well enough, then please, whoever asked that question, to get in contact.
Yeah, and if can you go to slide 4? I think this question just more clarification, like because whether it's the office decline 17% over 3-year total and it's not annual. I think it's come from mostly like that.
Where we go?
Right there. One more. Oops.
There we go.
Yeah, so one more. I think that the 3-year annualized number, right? So there's one each year, like so.
Which one? That one?
Yeah, I think that one. Yeah, I think it's not 17%, it's negative 1.7 annualized kind of total return. Right? So, but yeah, I think it's decline is actually more. When you look at it, the decline is 10.9% on total return, right? So, but this is in total return, not appreciation. So you add on a 4, so it's definitely kind of more than the 10-something decline.
Yeah.
I know there's question as well associated to public and private, right? So I know that we're trying to address that during our article rather than there's a whole 1-hour discussion by itself, right? So we will, I think, as part of this, we will send that article as well. It's published in PREA, right? So talk about public versus private, and in there as well, I know that a lot of questions regarding the office valuation in there, right? So, but yeah, and then also talk about basically the transaction versus kind of the valuation. So we will send that around as well as the slide, as well as the recording of the video. I'll take one more question, I guess. Then we want to appreciate everyone's time in here. So one more question is basically, is historical average spread between valuation yield, i.e. cap rate and 10-year treasury, is reasonable guide to where the yield should settle in the future, right? So I think that I can take that one, right? So generally you can set that as a guide. However, like if you look at this time around, it's a little bit different, right? So what I mean is different is basically you got strong inflation, right? So you got strong inflation, you got strong fundamentals still, while on the finance, unlike previous recession, usually both fundamentals weak, right? And then you get challenged in the capital market, right? So this is challenge is much more in the capital market, but fundamental are still pretty strong, right? So again, it's a good guide, but I think that there's differences between kind of this time around and previously as well. Okay, again, we hit the bottom of the hour here, so I just want to make sure that basically we want to make sure that we end early because I know people are meeting here and there as well, right? So, but yeah, so we will address some of this question. I know some of this question is asked. Basically, we will address it during our one-on-one with our client.
Yeah, and we definitely look forward to those over the coming weeks. So if you haven't put those in, I think pretty much everyone has, then we certainly look forward to having the conversations with our clients over the course of the next few weeks. But obviously, thank you everyone for dialing in today.
Thanks all.
Thank you, everyone. Thanks, Robert.